Welcome everybody to today's RightTraining webinar. Today we're going to be looking at the fundamentals of life insurance within RightCapital. My name is Jordan. I'm on the customer experience team here at RightCapital. Today we're going to be looking at life insurance within RightCapital. We're going to cover data entry, proposing life insurance items, life insurance analysis, some presenting tips, and just some additional best practices along the way. So we'll dive into that in a second, but just quickly first, just some housekeeping notes. The session today is being recorded, and we're going to send you a copy afterward. It takes about 30 minutes after the close of the webinar. So what I like to say is definitely, during this webinar, sit down, get comfortable, trying to absorb as much as you can. And then if you're going to do the life insurance data entry later, you'll have that recording available. So you can just pull that up, stop it, start it, rewind it, whatever you want to do. So definitely, again, try and do your best to pay attention, get as much as you can out of it. And then again, you will have it later. So you don't have to worry about that. We're also going to have a Q&A at the end. So please feel free to drop any questions you have into the chat as we go. Given time, I'll make sure to cover as many of those as we can at the end. Just keep in mind the way Zoom works, I can't really see the chat until the very end. So if you say something like, oh, do that again, I won't be able to know what you were talking about. So definitely just make sure you keep that in mind if you send any questions in. But with that, we are ready to get started. So life insurance. There's obviously a lot to talk about with this. Today, we're doing mostly an overview, so I'm not going to go super in depth on any specific policy or anything like that. But we're just going to give a good overview so that when you're working on a life insurance scenario or presentation, you have a good idea of where to start, what you're going to be doing, what you're going to be presenting. Typically make it a little bit easier. So obviously with the life insurance, it is a legally binding contract. Insurer provides death benefits to beneficiaries after the insured party passes away. So the insurer guarantees a death benefit as long as the policyholder has paid their premiums outlined in the contract. Now, typically these life insurance policies include a death benefit that allows beneficiaries to maintain their standard of living once the insured party passes away. And that's kind of an important point. We're going to get more into that with the actual life insurance analysis portion. But with that kind of preamble out of the way, I'm going to share my screen for everybody. Make sure everyone can see what I'm seeing. So bear with me just 1 second here. There we go. All right. So I'm starting here on the advisor portal. This is the typical, the first page you're going to see as soon as you log in. Today, we're going to be using my Skywalker plan. This is the plan I use for all webinars if I can. Yes, I am the coolest person at the RightCapital office, if you haven't been able to tell already. But with that, we're just going to jump right in. And what I'm going to do here is we'll get started with life insurance in just a moment. But really quickly, I'm just going to shoot over to their blueprint. Just kind of give you an idea of what this plan looks like going in. The plan itself is very strong. They have, I believe, a 100% probability of success. They're not struggling by any means. Luke and Mara here are both in their late 40s. Ben, which is their son, is 16, so they do have college costs on the horizon. As you can see, they have a good amount of assets. They have some jointly held accounts. They have a primary home, a vehicle, a couple of loans, like a mortgage, 401ks, the whole kit and caboodle here. So they're doing pretty good. Goals, again, Ben's going to college soon. They're planning to retire in roughly 20 years, so 2044. And then they're set to start LTC and ultimately pass away around 2066 at age 90. So that's out of the way. Again, really quickly, we'll just take a look at their overall income. Currently, they're making a combined about $240 a year between both their salaries and a small side income. They both have their Social Security set up. And then they have a spread of different savings here from taxable accounts, 401ks, a 529. And they average about $8,000 a month in living expenses after things like their mortgage. So overall, very strong plan. I don't think they have anything really to worry about here. Again, they have a 100% probability of success. This isn't a failing plan. But all the more reason to talk about life insurance, because obviously things can get in the way, unexpected things happen. That peace of mind is definitely worth something. So we definitely want to make sure we are prepared for these kind of scenarios and just know what we're going to be talking about and how to add them to the plan. So we'll get started with the data entry portion of life insurance, which is very simply just how do we get a life insurance policy into the system? Obviously, this is a pretty good place to start. We need to know how to actually put these in the system. So far, it's actually very simple. To actually get this into the system, you're going to go to the profile net worth section. So this is where we actually input their assets. So things like bank accounts, investment accounts, loans. This is the page we want to be on. As you can see here, there's an insurance section closer to the bottom of the page. Now, if I click this open, currently I have one group life insurance policy for them right now on Luke. If I open this up, this is it. So this is actually the first insurance policy we're going to be looking at today, which is the group life insurance policy data entry card. Now, this is by far the easiest one to understand. It's very simple. Basically, what we're showing is who's the owner, what is the premium on the policy, what's the inflation on that premium amount, and finally, what is the death benefit. So again, this is a very simple setup. This is by far the easiest one to do. Again, if you know your premium, you know your death benefit, you can press save here. You're all set to go, right? So if I cancel out. Now, one thing I will mention, you'll notice there isn't a dollar value here, right? It's just blank, so it's not actually contributing to their total net worth. The reason this is, and we'll get through this in a little bit, is that this is just their death benefit. It's not a cash value policy, so they're not able to pull from it. So if you have a cash value policy, it will actually contribute to their total net worth. But if it's just something like a group life policy where they pay the premium and, if something happened, they got the benefit from it, then, it's not going to actually show up in their net worth because they don't have the money. And, someone would have to pass away for that to show up. So just a quick note, but overall, very easy. You know the premium, you know the benefit. You can throw it in here. Super simple. Now, that will bring us to the other life insurance policies we're able to enter, which gets a little bit more complicated. So if I drop down to this add account button over here, this is how we actually add items to the net worth. I can scroll down to insurance. Now there's obviously a lot down here. We're not going over all of these. We're just sticking with the life policies today. So the first 5, we just went over group life. Again, very simple, offered through an employer organization, covers an entire group of people under a single contract. Very simple, very popular, very simple. Next one up is term life. And by clicking this, it's actually going to add that policy to the plan. So we can actually see it right here. Luke's term life insurance is now appearing. Now, this is very similar to the group life. It's kind of like the next step in terms of how complicated it is. Now, term life is typically known as the simplest type of life insurance. It provides coverage for a set period of time, usually in blocks of about like 10, 20, maybe 30 years. If the insured passes away while the policy is active, the beneficiaries, receive a death benefit. Again, very straightforward. With that, it is very similar. So if you notice, the owner is still here, the annual premium and premium inflation bit is still here, and the death benefit is still here. There's just a couple of other items that have been added in to make this a little bit more complicated, but also more flexible. So first up, we have the insured. We do break out the owner and the insured to be a little bit different. So I can choose who's the owner of the account. You even have an option for a life insurance trust if you want to. But insured is a little bit different. So obviously, someone who owns a life insurance policy might not be the one who's also insured on it. So we do have a few different options. You can have it be the co-client or the other client. You can have it be one of the children. So in this case, I could make a term life insurance policy for Ben. That's something I wanted to do. Ultimately, again, it's just ensuring that, hey, the owner isn't always the person who's insured. So that is important to mention. Now, you do also have this option for the beneficiary percentage. What this means within our system is very simple. It's just, hey, if Luke is the one that passes away, let's say Luke has a policy on himself. If he were to pass away, when you have a 100% beneficiary percentage, that means 100% of the benefit goes to the co-client or the surviving client. Same thing if the co-client were to pass away first. If Mara had the policy and she passed away, 100% would go to the surviving client, who is Luke in this case. Now, if that wasn't the case, if say 50% of the benefit was supposed to go to, let's say, Luke, and 50% was supposed to go to Ben, you would want to set this down to 50%. Now, what it's not going to show is 50% of the value literally going into an account owned by Ben within the system. That's not quite how it works. What you'll see is 50% of the value will go to Luke, and then you'll actually see 50% of that value in their estate tab as going out of the estate towards one of the children. So just very important to keep in mind, we don't model, some scenario where like that 50% turns into a different account or anything like that. It's just ensuring, hey, when they pass away, what percentage should go to the surviving client for the system's purposes, making sure we're actually able to use that money. So definitely very important to understand Just wanted to give a quick shout out to that. Past that, very simple. We just have options for the premium ends date and the policy ends date. So again, this is a term life. It does have a set time limit. I can go in here. You have a ton of different options. I can say, hey, this one ends at Luke's retirement. If he gets to retirement and he's still alive, the policy will just kind of phase out. So definitely important to mention. But overall, again, very simple to understand. Just a few more data entry items from the group life insurance. So I'll actually delete this one. We'll go to the next type of life insurance, which is going to be whole life insurance. So traditional whole life policy is a different type of life insurance contract that provides for insurance coverage of the contract holder for their entire life. So unlike term life insurance, which is just a specified amount of years or age limit, traditional whole life policy never runs out. So if you notice, there is no policy end year on here. There is a few different items. We're going to get through that in a second. So definitely important to mention. Now, again, this is kind of a next step up in complexity, right? So we still have a lot of the same items we saw before. We have the owner and insured, beneficiary, premium ends amount, death benefit. That's all the same from the earlier policies. So again, that's no different. The addition here comes down to the cash value. Now, this is where it gets a little bit more complicated, and this is going to be the same for the next policies going forward. So we haven't looked at universal life and index universal life yet, but they're also going to have this cash value component. So it is very important to understand how this works. Now, one thing I want to mention is you do not have to put this detail in. If you just have a whole life policy that just continues on forever, great. You can skip the cash value. You don't technically need that in there. You can just set the death benefit to whatever it's supposed to be and leave it, right? But in this case, we do have this option for cash value, so we do want to definitely make sure we know how that works. Now, what I'm actually going to do here quickly, just make sure I have some details in there. I'll set that to 1,000. Now, couple ways to show cash value. Again, this does get a little bit more complicated. So ultimately, the first way is you can just plug in the direct cash value, and I'll leave this hovered there. This is what's actually going to show in their net worth, right? So if this is the scenario where like, hey, I have a death benefit, but I do want that to show as part of their net worth, great. I can come in here, set that to 100,000, and then I'll save really quickly just so we can see this. This is actually going to be reflecting in their net worth, right? So it's 100,000. If I decrease it again, just to 0, just so we can see here, this will drop down the net worth, right? So this one will actually reflect in their total net worth, which is important to realize. So I'll put that back. Now from here, again, this does get a little bit more complicated. So we do have something here called the cash value approach. And how this works is basically, hey, how is the cash value and some of the other items going to grow throughout the plan? The first option, not included, is like, hey, if you just have a set cash value, that's what it is. There's no difference in how it's going to look. You can just throw that in, press save, you're done. They have a $100,000 cash value. They have a death benefit. It's not going to grow throughout the plan. That's it. If you switch to simple growth, we get a few more items in terms of what this actually looks like over time. So the first is the crediting rate, which is effectively, hey, how is this going to grow over time? Now we set it to 1.5, which effectively just kind of values or shows like a cash increase essentially. But if you wanted to, if this is going to be more of like an index universal life policy, this is where you can switch it to something like a 3, 4, 5%, showing that it's actually growing with the market, for example. So that is definitely important to keep in there. For now, I'm just going to leave it at 1.5. We also have the annual fee. Very simple. This just reduces the crediting rate. So if they have a crediting rate of 1.5, but the fee is 0.5, put a 0 in there. Basically, it's just saying, hey, when they get credited, it'll only be for 1%. So you're kind of getting the net amount between the crediting rate and the annual fee percentage. Lastly is the loan rate. Basically, if they take a tax-free loan from the policy, what does that grow at? So for example, if they take a loan, I can say, hey, that loan balance is going to grow at 2% if they take from it. Now, that does bring us to the tax-free loan portion. I know there's another cash value approach. I'm actually going to wait to go over that for the next policy because it gets a little bit more complicated. But here we actually have the distribution options. Now, again, this gets very complicated. This is where we start talking about the fact that there is a lot of different life insurance policies out there. I used to be on support. People would send us their different policies and ask us to help them walk them through it. So what I'm going to do here is I'm definitely going to recommend 2 things if you ever run into issues with the anything related to life insurance, which is we have fantastic resources available that can absolutely help you if you ever run into trouble. So the first I'm going to pivot for really quickly is the Help Center. The Help Center is a fantastic resource. Believe me, we've spent many hours in here making sure this is up to date. We have all the up-to-date tax information. It has everything you could want in the system. It has training videos, how-to videos. It has different walkthroughs on everything in the system. For example, if I look up life insurance, help if I spelled it correctly, I can get different options on the life insurance analysis module. We'll go over later how life insurance works, the data entry in the different cards. So for example, we're in whole life insurance right now. I can click that, and I have a full article that walks through the data entry process for whole life policies. So again, the reason I'm showing you this, you are not alone. You have fantastic resources at your disposal. Again, life insurance can be very complicated. There's a lot of moving parts to some of these policies. Sometimes deciphering them is the hard part, similar to something like a stock plan. So definitely, if you ever run into any issues, definitely check out our Help Center. It's always available in this little blue dot at the very bottom of your screen. You have this option to search our Help Center, which will bring you right to that page. You also have access to our fantastic support team. This is a great group of people. They are very well trained. They know the system inside and out. I was on that team before I was on the customer experience team. This is where I learned everything about our system and can now do these presentations. So again, can't stress it enough. Great group of people. We will, if you send in a chat, we get you a reply in under a minute. We're always available on the phone, 9 to 6 Eastern, Monday through Friday. So again, definitely just give them a buzz if anything comes up. Great group of people. Definitely miss being on that team sometimes. Anyway, moving back, I'm being a little nostalgic about the support team. I'll get us right back to the actual data entry portion. So tax-free loans. Couple of different ways to distribute from life insurance policies. The first, of course, is the loan. Very simple. What you can do, set the amount you want to pull, set how many years you actually want to do that. So in this case, I can just set it to, hey, I only want to do it 1 year from 2026 to the end of 2026. And that's basically it, right? So this is a tax-free loan. That is very important to mention. So this will show in the client's cash flows. So for example, if they're buying a house, they need to start pulling, liquidity from wherever they can get it. This is a good place to do that. Hey, I'm pulling $5,000 out from their insurance policy to try and make that payment happen. So definitely important to understand. Again, this is a tax-free loan, so it's not going to have big repercussions. There is another option for a full surrender. In this case, you just set the cost basis of the policy and the full amount, and then you'll see that come out again as an income source. Again, just important to mention that this will be subject to capital gains. So you do need to have that cost basis in there. You don't want to set a full, $100,000 cash value surrender and then a $0 cost basis, because they're going to have a pretty nasty tax bill when you do that. So definitely important to keep in mind. And then lastly, at the very bottom here, we have the death benefit option. Basically what this means is, hey, when we actually say the death benefit, is it just the face amount we put on there, or is it the amount plus the cash value? So that is very important to understand. Again, the thing you don't want to have is like, hey, this is a $50,000 death benefit and has a cash value of $100,000, and then the client passes away and they only get the death benefit amount. Obviously not great. So definitely something you just want to check on there. If you ever think that your insurance policy payout is way lower than it should be, this is probably why. So you always want to double check that. But anyway, that is basically it for the whole life policy. Again, we're getting a little bit more complicated. I know I haven't gone over this yet, but we'll get to that just in a second. But that is effectively how to do the whole life policy. So moving on, again, getting a little bit more complicated, we're going to go to the universal life policy next. And I will say, in universal life and index universal life are very, very similar. In fact, they actually have the exact same data entry process. So if you can understand how one works, you understand how the other works. So I won't spend too much time in this one separately, but I will go through this one in a little bit more detail. So universal life. So universal life insurance, again, a little bit different. It's another type of permanent life insurance coverage that offers more flexibility than just like a normal traditional whole life policy. So like whole life, it is lifetime coverage, but it does include that cash value component, loan options, flexible premiums. I know those are in the whole life policy for the sake of simplicity, but this is really where you're going to run into that a little bit more. So definitely going to spend a little time with that. So again, similar to with the other policies, again, there's a lot of familiar things in here, right? We got the owner, insured, beneficiary percentage, premium information, death benefit, and we got all that same cash value information. Now, again, this works the same way I mentioned it with the whole life policy, but now I'm going to go through this use illustration portion. So again, stick with me here because this definitely gets a little bit more in depth. Now, as you might have seen from the simple growth options, this is a little bit simplistic, right? We have the crediting rate, we have the annual fee percentage, we have the loan rate, but obviously this doesn't give us tons and tons of flexibility with these life insurance policies. Again, these life insurance policies are very complicated. They have lots of different rules about them. You might be able to take out loans in certain years, pay it back in other years, then start another loan balance on top of that. Again, this gets all very, very complicated. That's not something we can control just with these options. This is where the use illustration portion comes up. So if I actually click that, you'll notice all these options go away except for the death benefit option here. And then this mention of a detailed schedule. If I click edit, this brings up this table. And again, I know this is very intimidating, but I promise it's not that bad. And this gives you a lot of flexibility. So please just stick with me for a moment. So what are we looking at here? Effectively, the illustration is just, as it mentions, a full illustration of what everything in the plan is going to look like over time. So the premium amount, the loan income, the current cash value, and the ultimate net death benefit amount over time. Now, if I scroll down, there's obviously a lot of stuff going on here. In fact, it actually goes past when they would normally pass away. What I'm going to focus on is probably what most people will focus on, which is probably like the next 20, 30, maybe 40 years of a policy up until the actual end of the plan, right? So how does this work? Effectively, the benefit of this is I can go into any one of these four columns and put down exactly what something should be at a certain time. So for example, let's say I'm in 2025. I know the current cash value is 100,000, right? But I know this is going to grow over time. And by, let's say, what is it, 2025, let's say we go down to, say 2045. So around the time they're going to end up retiring, right? Let's say over the course of 20 years, I know that cash value is going to go from 100,000 to, let's say, 250. So it's going to gain a net 150,000 over the course of time, right? Now, obviously, there's a lot of different items here that we have not filled in. Now, you can, if you want, go through and say, okay, this is 112,000 or 112,000. This is 115,000. You can go down all the way. I definitely don't recommend that. Nobody wants to do that. That would take hours to set this up. Instead, what you can do, especially if you know your beginning value and your ending value, you can go to this quick fill option right here and use this interpolate option. This is the one I definitely recommend you use. This makes this process a lot easier. So again, if I know my starting value and I know my ending value, and by the way, this works for any of them. So I can do, let's say 2,000 here, put this at 1,000. I'll just set this up for all of these. Say net debt benefit is 150, and this will jump up to 300,000. What I can do, once I have my beginning and ending value, I can go to quick fill, select interpolate, and it will fill in the blanks. So if you have specific growth you need to see, obviously this will adjust that a little bit. However, what this can do is just make sure like, hey, if you have a start and ending value, we can gradually get it there over time. So that is very important to realize. Again, I've run into a lot of situations where it's like, man, I got this really complicated insurance setup. I don't understand how that's going to work or, what that growth is going to look like. It's like, look, if we can just find the ending number based on the growth you're expecting, we can just get the results immediately. So I definitely recommend, there is a lot of flexibility here. This can make it easier to work with. A really good tip I ended up using a lot back when I was on support was, look, again, if you're confused about how this growth is going to work, find that beginning cash value number, find the percentage of growth you're kind of expecting, plug that into a growth calculator. You can just look them up online. They're on Google. It's very simple. Just plug in the percentage interest rate you're expecting, plug in that beginning value, put in the amount of years, get that, put at the end, and then you can get that growth. You can then make adjustments over time, right? So I can go in and say like, okay, well, this should be 195 or whatever. However, the rest is basically done for you, makes it a lot easier. So definitely recommend that as an option. Now, there is another option in here, which is use simple growth. This gets a little bit more complicated, or it's a little bit simpler, but maybe not as helpful in my opinion. If I go to clear all, so I can get everything back as they were, what I can do is actually go in here, set the starting amounts that I know of. So I can say, let's say this is 100,000 like I had set up before, right? Now, when I go to the detailed schedule, I can actually just use, I'll clear this again, use simple growth, and it will actually just use those starting values and start growing them over time. Now, it will only do it for things like the cash value. You need to actually set the percentages of growth if you want to use this. So for example, if I go back, I would need to set up all these details. If I leave these blank, they're not going to show up. So if I go to that, go back to the detailed schedule, clear all, and then go to use simple growth, it can put that in there, but ultimately, it's definitely not, doesn't look quite right. So it's just something you want to keep in mind. Now, again, I know I just went over a lot. Obviously, this gets very complicated very quickly. It's meant to be flexible for these different kind of insurance policies. So one thing I'll mention, if I actually cancel out of this, delete this card, and go in here. Obviously, these do not cover every single type of insurance policy out there. There's a lot of very complicated policies. There's like joint policies where it's like half universal life and maybe half disability and things like that. We don't offer support for every single insurance policy out there. That being said, these are typically flexible enough that you can make it work. So a great example I came across a lot is like, hey, I have a joint disability and life insurance policy. Just build it out into two parts, right? If you have, your individual disability, you can put in that here, go over all those benefits, and then you can just build a separate group life insurance for the insurance portion of it. So they won't necessarily be connected, but ultimately, if you set your dates up right, they end up kind of being like two parts of the same policy, which can definitely help out. Another recommendation I make sometimes, again, these policies can be very complicated. You might have to pay back some of the loan income that wasn't actually shown in the system. So again, common scenario we've seen sometimes is, hey, they have a universal life policy, but they already pulled the money out. So I don't want to show them pulling more money out of the policy if it's already happened. What you can do, hey, set up the insurance policy, set the cash value to what it should be, maybe set the cash value policy to grow over time. So for example, I could go in, I'll use the index universal life. Again, this is pretty much the exact same data entry policy process as the regular universal life policy, so I won't go into too much detail here. And as I mentioned, this is an IUL. It's a type of permanent life insurance that combines the lifetime protection of a cash value component linked to the performance of a market index. So again, very similar. However, what I could do in a scenario like I was mentioning where we've already taken the income out, what I can do, set up the details of the policy, put these all in. Let's say I do that again. I go to the cash value, put in 150,000, go to, let's see here. So in this case, what I could do, I don't want to show the distribution again. That's not something I want to do. What you can do is, hey, put in the cash value, make sure that's growing at the correct rate, press save. And then if they're paying it back, just go to expenses, add another expense. So if they're making payments back to that policy, just make sure the cash value grows at the correct rate, even given the extra payments they're making. And then just go in here and put in that expense. You can even set it to be taxable or a W-2 deduction or anything like that if you want to. So again, it's just making sure that the portions of the life insurance policy that matter are in there. Again, we don't have support for every single insurance policy, but typically we can make it work. Again, I'm going to support or call out our great support team. They're very good at setting up these types of policies. Again, I've run into many different scenarios where it's like some very complicated life insurance policy we have to decipher and get into the system. There's absolutely a way to do it for the most part. There's very few instances where I got to a life insurance policy and went, we can't do it, right? So again, just ask for help if you need it. We're definitely very experienced with those kinds of options. Now, anyway, again, I would love to spend more time with the data entry, but we do need to keep moving. So again, if you have any questions about the insurance data entry process, again, we have the help center, we have our great support team, and again, we have a little bit of time with Q&A at the end, but I do want to make sure we get through the rest of the kind of life insurance process today. So the next place I want to look at today, let me make sure I got this all evened out. I'm just going to use the group of life insurance for today. The next place I want to look at is the retirement section. Now, I'm not going to spend a ton of time in here, but I do want to make clear that you can propose a different insurance policy outside of the current plan. So super quickly, when we're in the profile, we're building the current plan, right? So what we're saying is, hey, everything that's in the profile, that's kind of our baseline. That should be kind of the, again, baseline or current plan for the system. But let's say we have a scenario where, hey, I want to do an alternative scenario where they actually buy an insurance policy and put that into their plan and compare the two. We can absolutely do that. So what I'm actually going to do in this case, I'm actually going to add a new plan to look at. So I can go to the retirement analysis probability page. I'm going to press this little notepad option here. I can click in. I'm going to add a new plan. I'm going to call this the, let's say, extra life insurance plan. Check that off, press OK. I have that as an option now as my proposed plan. So I'm going to select that one right here. Now, by default, it's pretty much just going to be an exact copy of the current plan. As you can see, their median ending asset values are exactly the same. But now I can go down to the action items. I have full control over what I can put into this extra insurance plan, this proposed insurance plan, which gives me a lot more access. What I can do, scroll to the very bottom of these action items, go all the way to edit right here. Now, this is going to open a bunch of different items. Obviously, there's a lot here. These are all different items from the current plan, including our existing insurance policies. What I'm going to do for this example, I'm going to actually add the planning horizon here. Just a couple different things here. I'll explain this a little bit later. I'm going to make these available as options within the plan. And then what I can do is go to add new items, go to insurance, and let's say I want to add, let's just say I want to do term life. We'll keep it simple, right? So what I can do here, I can set this, let's say it's going to be Mara. She's insuring Luke. Maybe his health isn't as great as it used to be. Purchase year will be, let's say, next year, just so we can see that. We'll set the beneficiary percentage. She's going to get 100% of the benefit. Let's say it's going to cost him $1,000, and death benefit is going to be, I don't know, let's say $250,000. Again, that might not be accurate to what most policies look like, but this is just an example. So I'm going to set the policy to end. Let's say premium ends at Mara's retirement. In this case, maybe she's getting it through her work or something like that. Policy ends same time, so Mara's retirement, and press save. And what we're actually going to see is that insurance policy pop up here in the bottom right. So if you can see now this green dot right here, we've actually added a life insurance policy to this plan. And what you can actually see already is that the median ending asset value has actually changed, right? So now they have a little bit less money in this plan than they did in this one, most likely because they're paying the premium on this insurance policy. Now, another thing I recommend with these scenarios. So obviously we're doing this as a life insurance scenario, right? With the expectation that we are protecting against one of the clients passing away. Well, we can actually propose effectively an early death scenario within the retirement analysis. So what I can do, and actually it looks like my item didn't stick there. Let me go back to edit. What I can do, I can add in Luke's planning horizon, so his expected end of the policy and his LTC. So I can add in both these items to this proposed plan, press save, give it a second to load. And then you can see these appear right here in the top left. What I can now do is say, hey, early death scenario, Luke passes away at 60, right? What happens? I can also set down his LTC. We want to make sure that LTC doesn't trigger that early. It doesn't really make a lot of sense. So I'm just going to set that to 0. I can now press refresh, and we can actually see what happens to the plan if that were to occur. We can actually see, because Luke passes away early, their probability of success goes down. Their median ending portfolio value goes down. But now we're actually going to get the payout from this term life insurance. And we can actually go see what that looks like too. So if I go over to the cash flows, so retirement cash flows, I can switch viewing to the extra life insurance plan. Give it a second to load, go to summary. And then what I can see here is, hey, when Luke hits 60, he actually passes away. And we're going to see an income startup, which is an insurance death benefit between groups, basic group life insurance policy and Mara's term life insurance, right? So because we have both of those on there, they now show up in the cash flows. And just super quickly to compare, if I go back to the current plan, we shouldn't see that in there because Luke doesn't pass away, right? So if I go back to where Luke's 60, he keeps living. There's no insurance payout. We're probably not going to see that till the end of the plan anyway. Actually, in this case, it would technically go to their estate, so we wouldn't really see that here anyway. But anyway, that definitely covered something that is very flexible. There's a lot of info here. Obviously, proposed plans on their own have a ton of different details. I'm skipping over a bunch of details here. But the main thing I'm just trying to show is that you can build a custom life insurance scenario. Again, it's very simple. We have that in here. I can actually click open the card make further adjustments if I wanted to. And again, the way I did that, I went to retirement, analysis. I made a new plan right here, a life insurance plan. I selected it on the left-hand side. This means that this is the plan I am actually modifying when I go down to the action items, right? And then I can scroll down, go to edit, add new items, meaning we're adding an item to the proposed plan. Hover over insurance, and we have our life insurance options right here. So again, if you're ever running into a scenario where they actually have to get into a life insurance policy, you can definitely do that here. There's a few more items in here that, you know, can come up. So things like when you get in the cash value, we will actually show them paying that out, right? So if there's more than just a premium amount, you can do that. In fact, maybe they need to make a larger purchase, you know, for whatever reason, you can actually set that up, go to illustration. Maybe the premium in the first year is far, far larger than it will be from then on out, right? So again, the main name of the game here is flexibility. You can propose these outside of the current plan. So if you're looking at a separate life insurance scenario, you know, you can definitely do that. So again, can't go much further than that today for time, but definitely a super important part of the system. Now, time to get to kind of the bread and butter of insurance analysis in RightCapital. So we have this insurance tab right here at the top. So if I go right here, the very first page that should load up is our life insurance analysis module. So this is a very specialized module within the system. I'm going to spend a little bit more time here, as much time as I possibly can, kind of going through this. Obviously, life insurance itself is a very common part of the financial planning conversation. What this tool is designed to do is really help us visualize the impact of a client or co-client passing away. And that's going to be done 1 year from now, right? So basically what we're trying to show is whether there is enough protection in place to support the surviving spouse through the remainder of the plan. And that's really the core of what this module is doing. So if you take away anything from what we went over today, let it be this. You know, the calculation here is asking the question, what amount of life insurance coverage is needed to ensure the surviving spouse ends the plan with a positive portfolio value? And again, this is very important. I'm going to say it one more time. What level of life insurance coverage is needed to ensure the surviving spouse ends the plan with a positive portfolio value? That is ultimately what we're focusing on in this module, right? So what you'll notice right off the bat, so as soon as we open this life insurance analysis, we have these two graphs right here. So you notice that the module breaks this out into separate visuals for the main client, who's Luke in this case, and the co-client, which is Mara. So each scenario assumes the loss of that specific person and evaluates the kind of financial impact on the surviving spouse, right? So when I'm looking at Luke's life insurance analysis, this is assuming, as it says right here, what if Luke passes away next year, right? So when I'm looking at this side, that means that Mara is the surviving spouse. And when I look over here, this means this is Luke if he's a surviving spouse, basically. Mara means she's passing away. Luke means he's passing away. Pretty simple. So where this tool becomes really powerful, though, is when we start to fine-tune the assumptions here. And I'm going to go through this piece by piece because, again, this is very specialized and can be a little bit complicated. So right here on Luke's life insurance analysis, we can see we have these two kind of bars here. We have the protection need, and then we have the proposed insurance and the current insurance. So what does that mean? Protection need is effectively saying, hey, assuming Luke passes away January 1st of next year, what is the recommended minimum amount that the surviving spouse would need to get to the end of the plan without running out of assets? And again, I'm going to stress the wording there. It's the minimum amount. When you see protection need, the emphasis there is on need. This is the floor. So what it's basically saying is, hey, if they're under that life insurance amount, they're in trouble. Anything above that, they should be okay. But if you were under this protection need, the surviving spouse is at a risk of running out of assets within this plan. So again, super common point of feedback we get. Some people I speak to on the phone say like, well, shouldn't that be the amount they should just get, period? And that's not necessarily the case. Obviously, life insurance analysis is kind of different for everybody. Everyone needs a different level of cash to feel comfortable. We're not aiming for that because that can be a bit of a gray area. What we're aiming for is that floor. So again, super, super important. If you leave anything or leave with anything today, definitely let it be this, that the protection need is the floor for what they need in terms of life insurance. Now, this amount on the right here, very simple. This is just the amount we already have in the plan. So where it says current insurance is just saying, hey, this is the amount you plugged into net worth, right? So if you remember from earlier, I have a group life insurance policy that's $50,000. That's why this amount shows up here, right? Now, if you notice, there's another item here for proposed insurance, and that's where these action items at the very bottom are going to start plugging in. So another super important part about this module is that you do need to make some modifications. Obviously, if we're assuming that one of the clients is passing away, that is going to have massive impacts in the financial plan. It's actually pretty hard to understand maybe every single area that's going to end up affecting, because it'll probably affect just about everything, right? So there's different things I want to plug in here. And the reason I want to do this is to try and refine this down as much as humanly possible. So what I'm going to do is say, hey, if Luke passes away next year, how is the plan going to adjust? Is Mara going to live as long? Is her income going to stay the same? Are her savings going to stay the same? What happens to their pre-retirement living expenses? What happens to their debt? Again, chances are these things probably aren't going to stay the same. So to give you a very basic scenario, Luke passes away. Well, Mara might have to work less. She might have to go down to part-time or find a new job. Maybe that pays a little bit less. Maybe she's able to save a little bit less because of that as well. Maybe the expenses go up or down. Now, one thing I will mention, the only default assumption we will make when a client passes away is that their pre-retirement and retirement living expenses are going to go down a certain percentage. How can I see what that is? Well, super quickly, just I'm going to save my work here real quick. What I'm going to do, I'm going to go to this gear icon at the very top right, go to settings, and then I'm going to jump over to this other assumptions tab right here, right? So gear icon, settings, other assumptions. I'm going to open this up. And if I scroll all the way down, there's this note right here, expense adjustment upon the death of a co-client. Again, what that means, the percentage which the living expenses will be reduced after the death of the client or co-client. And it says it right here too, if you ever kind of lose it. Very simple. I can just set this to customize, and I can say, hey, they're only going to drop by 10%. Maybe they're going to drop by 20, maybe even 35, whatever. You can customize that. But again, this is really only the automatic change we're making past just ceasing the income of the person who passed away and things like that. So definitely very important to understand. In this case, I'll just leave it as 15 for now, which is my global assumption. So that'll work for today's example. Jumping back real quick, go back to life insurance, back to here. Again, so what you need to keep in mind is that this expense number you have here is going to get dropped down by 15%. But, in this case, I'll say it actually goes down a little bit further just for this specific example. Maybe they go down to 7,000. They really cut costs. Debt strategy, how are they going to pay everything off? Do they want to pay off all debt immediately? Do we want to follow a debt proposal that we set up in the debt module, or do we want to keep our current payments? In this case, I'm going to keep it to current payments. So I'll leave it there. Now you can add additional items. So if I go down to edit, right here, you can see I can add in a ton of different items here from all across the plan. I can add, let's say, Ben's college goal, the retirement monthly expenses. Let's say I add that side income in. Let's keep going here. These can stay the same. Maybe they're 529 savings. And I'll leave it at that for now, right? But as you can see, there's a ton of different items. I can add in any possible home relocations they have later in the plan, asset sales. Actually, for this example, maybe I need to sell Luke's car a lot sooner, things like that, right? So I can press save. And these will actually add these items to this life insurance analysis. So again, typically you want to get as detailed as humanly possible. Obviously, it's very difficult to try and predict all of this, but it is definitely important to try and build out as much as you possibly can. So for example, maybe I go in and Luke or Ben needs to maybe shoot for a slightly cheaper college. Actually, this is Luke's side income, so this will just cancel out, so we don't have to worry about that. Mara's 401k goes down. Maybe she's able to put a little bit less into the 529 as well. And, maybe we need to sell. Actually, in this case, we can't because Luke owns it. It's technically going to get sold a lot sooner. But, we need to get rid of this a little bit sooner. But anyway, so once these are all in, I can press refresh, and we will actually see this reflect in the rest of the plan at the top. So if I go here, we can actually see our protection need has changed quite a bit. So because we've adjusted all these items, we can now see that the life insurance has jumped up to about $300,000. So definitely a lot more than that initial 100,000. And this is why it's so important to kind of go through and do these items, because you don't know how much this can actually grow once you've adjusted it. Again, we only assume a slight drop in their expenses by default. So it is really important to go in and kind of nail down these adjustments. Now, with all that being said, again, we have this proposed insurance item here. What I can now do is go in and actually propose, okay, yeah, we definitely need to raise the amount of life insurance we have. 50,000, maybe like your default work policy that you maybe just get by working there isn't enough. We really got to pump this up to 300,000. I can refresh, and now we can see, okay, we've at least hit that kind of protection need. We've gone a little bit further. That will definitely help out in the long run. Again, anything above the protection need definitely warrants a conversation. There might be some clients that just want the bare minimum, which is that protection need. There's some clients that want to feel a little bit more comfortable. Again, the note I want to make is that the need is the floor. You probably want to be above it, but you definitely do not want to be below it. So that is very important. Now, one quick thing I'm going to jump to before we get through the rest of this is the floor, but I really need help nailing how much they actually need, right? Maybe the floor isn't enough. Well, there is one more thing we can look at that can make this a little bit easier. Try and nail down that number you're looking for and make this, just a little bit more of a simple conversation than trying to prove a bunch of numbers to people and trying to convince them they need more in life insurance. And that's through another page in the system. So if I actually go up to this gear icon up here, or excuse me, if I go up to these three dots right here, this is called the More menu. If I click that, it's going to open all these different tabs here. The one I'm looking for is right here, so where it says calculator. So if I click that, what this actually does, this is a human life value calculator for both clients in the system. And what this actually shows is, hey, assuming things kind of progress like normal, they had their, normal income, they had their, normal stretch to retirement, tax rate, whatever, how much money would they have made in their lifetimes, right? So in this case, I can say, hey, if Luke made his income and worked all those years to retirement, he would have made about $1.4 million. What this can act as is your ceiling. So we have the protection need from the insurance analysis module. Now we have effectively a ceiling. So we know that, hey, under $300,000, we're in trouble. But at most, he would have made about $1.48 million over the course of his lifetime. So we know, hey, okay, we probably want to be somewhere in the middle there to feel comfortable. So maybe you want to go directly in the middle. Maybe you want to say, well, if we can just do like 25% of the human life value, that's probably going to be a lot better. Again, you can make this work in a number of different ways, but the important part here is just that you have multiple data points you can work with. So if you're really struggling to figure out, like, I just don't know how much money I think they really need in their life insurance, you can definitely set this up to work a little bit better. So definitely something you want to keep in mind. But anyway, I will get us back to the insurance module. I just really like to mention that part because it can definitely be helpful in that conversation. But anyway, we're back to the life insurance analysis module. We now have an understanding of generally where we want to be. We have a protection need built out. We have our current and proposed insurance. What do the rest of these tabs do? Well, if I actually click over to Luke, now both clients get a separate tab here, right? So what I can do is actually go through and say, hey, in a graph format, what does their income look like, or retirement income specifically, if Luke passed away? So in this case, I can see, well, they're going to have mostly savings withdrawals, maybe a little bit of Social Security. I can actually click this, see what their invested assets will look like over time, right? So I can see, hey, in the current plan, they actually run out of assets really quickly. But in this proposal, they actually managed to keep their assets for far longer. Here, they probably hit LTC, so there's a big drop. But ultimately, we can see what the difference looks like. In this case, the current plan is quite literally just the insurance we have here at the very bottom. And the proposed is the additional amount we added on, right? So we can see, hey, if we have that proposed amount, this looks a lot better. I can even decrease this. Let's say this goes down to 150. Press refresh. We might see an income shortage pop up. There we go. So we can actually see like, hey, in this case, because we don't have enough, we actually have an income shortage. We'll even see that on this amount right here. We have quite a shortage, especially with LTC later in the plan. So we definitely want to be ready for that. Moving on, Mara, she doesn't have anything in her plan necessarily. This didn't have a protection need, so this is going to look pretty good. But just quickly showing that, hey, you do get one for both clients. So if Mara were to pass away, Luke ultimately does make a little bit more money, so he'll be a little better off. So just important to show what that looks like as well. Lastly, we have the details. And what this is, it's effectively just a cash flows view of the scenarios we just built out. Now, one thing I do want to mention, and I did kind of touch on this in retirement, is that if you really need to build a life insurance scenario in extreme detail with tons of different modifiers, you can actually do that in the retirement analysis. You can adjust their planning horizon. You can adjust all those different items. You can build out an even more detailed life insurance scenario there. Granted, you won't get access to things like this, but you will get access to the other graphs and details within retirement. That being said, if you're just using the insurance analysis module, which is definitely recommended for most people, you really only want to do the retirement method if life insurance is a critical item on someone's list and they really got to go super in depth with it. Maybe, I don't mean to be morbid, but maybe there's a bad diagnosis. They really got to be ready for something like this. Maybe their parents both passed from a certain illness. They really need to be prepared for it. You definitely would be over in retirement. But again, if this is most people and we're just trying to figure out what is a reasonable and safe amount of life insurance to have, then we can build that in this analysis module. And we still get a cash flows like view to kind of see what this looks like over time, right? So I can actually see, hey, if Luke passes away, this is what the cash flow looks like over time. We can see the income drop from 2020 to 2026 is significant, right? Because we're losing his salary. If I scroll down, we can see what this looks like. We have major negative net flows later into the plan. I can actually switch between all these different items. So for example, ending account balance, I can switch over to, and we can see, hey, eventually, even with a jump in life insurance early in the plan, we're eventually going to run out of money. It's just not enough. However, if I go back super quickly and set this back to 300, just so we can, make sure I can actually type that correctly. There we go. Press refresh. If I go back once this is done, no income shortage, I can go back to the details, go to that ending account balance. We can see they have much more in their taxable to start with. They never end up running out of money in their accounts. Definitely gets a little bit closer near the end, but they are okay throughout the rest of the plan. They are able to fulfill their negative cash flows. And again, there's just a lot more income early in the plan, which definitely helps out. Again, I'll just go through the rest of these just so you can see them. Again, this is basically just the cash flows, just with this scenario applied. So it gives us a little bit more details kind of going through. And that really does it for the life insurance analysis module. Again, definitely a lot you can do here. This is really the presentation tool we recommend when you're doing these types of recommendations. Again, the benefit here is you have these action items. So if they're coming in, you're trying to build a scenario, you can have that conversation. Hey, do we think this is going to affect your monthly expenses? Do we think this is going to affect the kids' college goals? Is your salary going to take a hit? Do you need to move in with somebody for a while and your expenses are going to get cut dramatically for a specific time period? All that type of stuff. You can build that in here, see what it looks like, and then you get those results. So especially if you're doing it in office with somebody, you can make those adjustments on the fly and then go double check. Hey, what does that look like? Do we have an income shortage given the detail we have in the plan? So definitely very important. Now, the last thing I'm going to hover over for today, or go over, excuse me, is actually printing a report. So if I go to this gear icon right here, go to report, we can, of course, print out the stuff we talked about today. So if I go over to the insurance section, there is a report for the life insurance. I can enable that. I can also add in my retirement. So especially the one with the proposed plan, I can actually add these in, and I can actually select maybe a comparison between the current plan and the extra life insurance plan, right? Press done. And even I can add in the detailed financial plan for the insurance. I'll even add in, I'll leave the balance sheet for now. Don't think we really need that. Press download selected pages. Give this a second to provide us a PDF. But that way, again, maybe you did your presentation in person, maybe you didn't, but ultimately you can get a PDF version of the plan with this information in it. Provide that to your clients so they have something to take home. If I go down here, we can see, great, I have the comparison between the extra life insurance plan and their current plan, including the Monte Carlo for the extra life insurance. Scroll down, I can see the differences between the two plans. So Luke passing away early And then at the very bottom, we got some extra life insurance assets in there. Going down even further, this is for the notes and the retirement analysis. You might not see that. But then we have our analysis for the life insurance. It goes over what the coverage was, what those graphs actually look like. Going further down, again, further action items in case we made more changes. See the impact, what happens if Luke versus Mara passes away. And then we have the details, right? So it doesn't print every page from life insurance by default. That is an open piece of feedback right now, but we can get all the important bits out of the life insurance. So definitely very important to go over. And then finally, we have the life insurance we had in the net worth. So definitely if you need to kind of give someone a takeaway document, these are definitely the ones I recommend throwing in there for life insurance. Obviously, if you have a broader plan, you can add in more. But just for life insurance, I definitely recommend those items. But yeah, that basically covers life insurance in RightCapital. Again, we didn't go over every single item in extreme depth today. Obviously, we could do an entire webinar just over different insurance policies and different examples of adding different policies. That's kind of a different discussion. But in terms of approaching life insurance in RightCapital, this is really how we do it. Again, you go to the net worth, you can build those policies in here if you just have them already. You can propose additional policies under retirement analysis. So if you're trying to show them purchasing a life insurance policy and how that affects their existing plan, you can do that as well. And finally, we have that insurance analysis. So just really making sure like, hey, what is a good amount of life insurance to have? Are we going to be at risk if someone were to pass away or not? If so, what do we need to kind of get above that? Again, I'll mention it again. This is the floor. You definitely want to typically go above that, but it just makes sure like, hey, you're not in immediate risk if someone were to pass away.